Ooh, baby, is that some epic annihilation of Intel stock? Welcome back to Strongman Personal Finance. Intel just reported their earnings. And what do you know? They had a double miss both on the top line and on the bottom line. Let's dive in and see why Intel stock is down 15%. Because I remember a lot of you calling me stupid when I sold this stock after I saw a massive decline in revenue that I was not expecting. Something is very wrong with this company. So, Intel reports after the bell second quarter 2024 financial results, announces $10 billion cost reduction plan to increase efficiency and market competitiveness. Oh, now you're deciding to cut $10 billion. Second quarter revenue of $12.8 billion, down 1% year over year. And when you factor in inflation, down even more. They were projected to have revenue of 12.98% or 12.98 billion. So they missed by like what, $180 million? Oh, that's nothing crazy there. Second quarter GAAP, generally accepted accounting principles, earnings loss per share attributable to Intel was negative 0.38. For every share of Intel you held, you lost 38 cents in the current quarter. Non-GAAP EPS, which is fake garbage EPS, attributable to Intel, was 0.2 cents positive. What were they expected to have? They were expected to have earnings per share of 10 cents. Instead of 10 cents, they had negative 38. Forecasting third quarter 2024 revenue of $12.5 billion to $13.5 billion. Expecting third quarter GAAP EPS of negative 0.24 and non-GAAP fake EPS of negative 0.03. Horrible forecast. They're forecasting to lose money. Now let's look at the revenue and compare it to the prior year. Let's see how much they're freaking down from the prior year. So their revenue in the third quarter of 2023 was $14.15 billion. Now they're guiding to a high of $13.5 billion. Their revenue is falling. It's projected to fall again. Bucket Braille here. Implementing comprehensive reduction in spending, including a more than 15% headcount reduction. So they're firing more than 15% of their freaking staff. Suspending the dividend. Remember, people said the dividend yield. The dividend yield. People were saying the dividend yield was all important. It's all about the dividend, like Sven Carlin, meet Spin Sven. I'm going to be reacting to him too soon. They suspended the dividend in the fourth quarter of 2024. They reiterated its long-term commitment to a competitive dividend as cash flows improve. Yeah, didn't I say this before? They should have cut the dividend a long time ago, okay? Oh, then they achieved some milestones, but their business is freaking collapsing, of course. And the CEO, Gesslinger, our Q2 performance was disappointing, you don't freaking say. Second half trends are more challenging than we previously expected, and we are leveraging our new operating model to make decisive actions that continue to produce losses for the business, okay? Second quarter results were impacted by gross margin headwinds from the accelerated ramp-up of our AI PC product, higher than typical charges related to non-core businesses, and the impact from unused capacity. Oh my God. So they have this cost reduction plan, okay? Basically, they're going to fire a bunch of people and try to cut as many expenses as possible. They're going to reduce operating expenses. They're going to reduce capital expenditures. All these other businesses are investing into the AI future. Intel is cutting capital expenditures. Reducing cost of sales. Yeah, okay, maybe you should have done that a long time ago. And then maintaining core investments to execute strategy. Cost of sales is just the cost of the products that they're selling, the direct cost of the product they're selling, okay? So we see the financial highlights. So revenue is down 1%. Gross margin is down. You know, before when Intel was the value stock, value my value, if you look at their gross margin, it was much higher back in the day, and it's been steadily getting eaten away. They're getting their freaking lunch eaten. R&D spending is up. Operating margin, negative 15.3%. That's a lot. Okay, funny enough, so you see they use the percentage points here to make it not as bad, to make it not look as bad. But that's over like what, a fifth or a massive decline, like what, 100% decline. Last quarter of this year, of the prior year, they had 7.8% negative operating margin. This quarter, they have negative 15.3%. And they lost $1.6 billion. on the accrual basis of accounting. In the second quarter, the company generated $2.3 billion in cash from operations and paid dividends of $500 million. Great job there. You should have kept the freaking money, okay? Okay, so operating model, blah, 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 blah. Let's look at their individual segments. So Client Computing Group, up 9%. Okay, well, they got a little bit of growth there. That's like the only thing that went up, right? Data Center down 3%. Network and Edge down 1%. All other. Altera down 57%. Other down 43%. And all of their revenue was going down except a slight uptick in Intel Foundry. Oh my God. And Client Computing. And that's not even strong revenue growth compared to these other companies. Oh boy, this is not looking good. So they announced the Q4. Why are you paying the Q3 dividend? They're declaring a quarterly dividend of 12.5 cents per share. Payable on September 1st. No, keep the freaking money. Okay, can we all come together as Intel holders and agree that you should keep your money instead of burning it on garbage? So, basically they're just trying to give a bunch of justifications about why they suck, okay? So we can look at their income statement a little bit. So obviously we know revenue is down. We know cost of sales is, they said they had some unexpected charges. R&D spending is up. Marketing down a tad bit. And restructuring and other charges, $743 million additional restructuring charges. I don't know, what is it, severance, firing people for for this quarter versus last year, okay? So overall, their total operating expenses increased by 15%. Their operating expenses increased by 15%, while their gross margin decreased. That results in big losses. Operating loss, they lost $1.9 billion from operations in one quarter. Gains and losses on equity investments. This is companies they own, they partially own, but don't fully control. They got a tax benefit, so it made their profit look a little bit better. So freaking amazing, okay? Let's see. Shares outstanding. Shares are increasing. They're issuing shares. Let's look at employees. They actually added employees. They have 125,300 employees as of June 29, 2024. Last quarter, they had 125,200. They added 100 employees. Why? I thought we were firing people here. Okay. Let's look at their balance sheet. So they got cash, short-term investments, and accounts receivable. So their liquid capital on hand is $32 billion. Their current debts are roughly $32 billion. So they have enough liquid capital to pay all their short-term debts. But they would have had more capital had they not paid declared the freaking dividend. Okay, keep the money on your balance sheet. Inventories are roughly the same. They're actually up a little bit. So sales are down, but inventories are up. That's interesting. Are they having trouble clearing inventory? We can see finished goods. Okay, they have a bunch of work in process, raw materials. Okay, so inventory is basically up slightly. That doesn't sound too great to me. Property, plant, and equipment. You can see they're investing a bunch of money in property, plant, and equipment. They had $96 billion as of December 31st, 2023, and now they have $103 billion that they've spent on property, plant, and equipment. So they spent a good, $7 billion investing in property, plant, and equipment for revenue declines. Equity investments, this is companies they partially own but don't control. Went down a little bit. That's because they suffered losses. Goodwill is down a little bit, probably a little bit of an impairment. Okay, nothing super crazy here. Let's look at long-term debt. So we see they just say debt of $48 billion. I don't know what that's for. Overall, not a horrible balance sheet. What I don't like is this. Look at this. Look at this issuance of stock. Common stock and capital in excess of par value. So we can see that they're issuing shares. As a matter of fact, they have diluted. It doesn't look like it's a crazy amount, but they've diluted roughly 1% in 6 months. So not the worst dilution in the world, but this is going to continue, I imagine, especially with the losses that they're suffering. And retained earnings is down because of losses. Okay, let's look at cash flows from operations. So we start with net income, then we do some reconciliations. Let's see. They add back depreciation. They add back share-based compensation. Restructuring charges and other charges. They had more than $1 billion of restructuring and other charges for the 6 months ended June 29, 2024, compared to the 6 months last year. $1 billion more. $1 billion in restructuring charges. Let's see some differences here in balance sheet items. So accounts receivable, basically they added it back because they collected some accounts receivable. They collected more in the first 6 months of the prior year. Let's see. Changes in inventory. So they had a little bit of net outflow purchasing inventory. Accounts payable, they had some accrued accounts payable, whereas they paid a bunch in the prior quarter. It's actually a lot worse than you might think because these changes in balance sheet items, the only reason the cash flow looks roughly the same is because of this difference in accounts payable here. They basically paid a bunch of accounts payable, short-term debts, in the first 6 months of the prior year, whereas they accrued them but haven't paid them yet. So this is probably going to wash its way out. This is going to wash out in the next quarter, I'm imagining. But the cash flow from operations isn't as good as you might think. So let's see. What do? They spent $11 billion on property, plant, equipment in 6 months for declining revenue. They got some government incentives money. They got $699 million on the government incentives. And we see some changes because of purchases and redemptions and maturities of short-term investments. That's immaterial. And other investing. Okay, so most of their money went into buying property, plant, equipment, but it's down from the prior year. Let's see. They added $5.8 billion of commercial paper, short-term debt. They're borrowing money. They paid up a little bit of it, but not all of it. They still owe about They still haven't paid off $3.2 billion of that commercial paper they borrowed. Partner contributions. What is this? Is this stock issuance? What does that mean? I don't know what that means. I've never seen partner contributions in my freaking life. I'm assuming that's stock issuance. Let's see. Issuance up. So they're issuing. They got $11.8 billion from stock issuance, almost $3 billion from long-term debt. Freaking crazy, man. Like, guys, this company is a freaking disaster. Hopefully you've learned not to purchase stocks because of a dividend. And if you think something is wrong and it doesn't fit your thesis, sell the freaking stock and be done with it, okay? Hopefully you enjoyed the video. Don't forget to hit like and subscribe. If you want a sponsored video, it's $50. See the pinned comment below. Buy my book, Stop Being a Broke Loser. It's on Amazon. And if you want a tutoring session in accounting, $75 an hour. See the pinned comment below. Talk to you later. Cheers.